All right, let's begin. Welcome back. I hope everybody had a nice vacation. Everybody get some turkey to eat. Anybody go deer hunting? I got one. Yeah. And then I went up to Ohio and I got a turkey too. It almost got me, but that's another story. All right, let's get into it. The homework 14, cost estimation, that's due on Wednesday. So if you haven't already finished that, now's the time to start. Also, I want to announce that we're going to have a bonus quiz on Friday the 10th. I think that's our last class period. And so here's how it's going to work. You remember that at the beginning of the semester you took a multiple choice quiz? It's the same one. And I'm hoping that you do better the second time around than you did the first time around. I'm hoping that it shows evidence of learning over the semester. And so it's multiple choice, 10 points possible, and if that helps your grade, then I'll factor it into your quiz average. If it would bring your quiz average down, then I'll throw it out. So it's just, it can only help you, it can't hurt you. Any questions about that? I don't imagine that anybody really remembers the questions from that the first time around. I didn't hand them back, so hopefully it'll seem like they're new questions, but now you know some more of the background. Today we're going to be starting on Chapter 16, which is depreciation. So any questions before we get into that? I've just handed back the projects. If you didn't already pick up your report, you can grab that after class. I was impressed. I feel like overall it showed a lot of effort and careful planning, and I hope that it was useful to you. I think it really came through in several of the reports that people were taking it as an opportunity to be serious about what their goals were financially, like for the rest of their life. And I think if I was going to pinpoint a few common mistakes, it seemed like a lot of people were planning to invest their life savings in just an ordinary bank account. And that would be a mistake because we've talked about how purchasing power will decrease over time if your investment yield is lower than the inflation rate. And so actually saving money ends up losing money if you're just going to put it into an ordinary bank account. There are plenty of safe places you can put funds that'll earn a better return than like 1% in a savings account. So, later on, your employer, when you get a job, for the most part, won't even give you the option. They'll force you to invest in a 401k, and you may have different places where you can put it, but most of those alternatives will yield a better return than just an ordinary savings account. So you've got a lot of work ahead of you as you get into your careers, and I think the power of compound interest is pretty amazing when you look at like a 40 or 60-year horizon of how much your savings can grow over time if you let compound interest do the work. I hope you remember that. All right, so depreciation is talking about the loss of value of property over time. And so here is a picture of two different vehicles. They're both Hondas, and very clearly the Honda on the left is worth more today than the Honda on the right, unless it's a matter of the Honda on the right being a collector's item because it's so old. I don't think that's the case. Depreciation is how almost everything has a decrease in value, not only with time, but as it's being used. And what we're going to be talking about is a little bit different from physical depreciation. What we're talking about is tax depreciation. It's kind of not necessarily an imaginary thing, but it's more about accounting than an item's actual market value. And so it's a deduction that can be taken against income. And deductions are a good thing, whether you're an individual or a business. You want to have as much as of your income deducted from taxes as possible. So if you have a lot of depreciation, what it means is that the amount of that depreciation is taken away from the profits that you earn in a year so that you have to pay less taxes to the government. In the same way that if you make a charitable donation or if you take old clothes to Goodwill, those things can lower the amount that you have to pay to the federal government in taxes. So can the reduction in value of your property under certain conditions. So let's begin with some terminology on this. The first thing that you have to keep track of when you're calculating depreciation is how much you initially spent on the item. And it doesn't just include the purchase price, but it also includes the transportation costs to getting it into the location it needs to be. It can sometimes also include the training that went into the amount spent to train new people to use it. So just whatever costs there were to make an item serviceable. Now, book value is how much the item is worth over time, and that's separate from market value. Market value is how much it's worth to someone else who is actually considering purchasing it. You know, if you go onto the classified ads or if you go to Craigslist, you can get an idea of the market value of items like an old phone or a computer or a car. You can just see what other people are paying for typical items like that. Book value, on the other hand, is calculated through several formulas we're going to learn today, and it's what the government considers your property to be worth. Sometimes it lines up with market value, most of the time it doesn't. Not all property is depreciable. For one thing, it has to be used for business or held to produce income. So if you own a company and you buy your kids Christmas presents, those Christmas presents aren't depreciable because it's not related to the business at hand and it's not used to produce income. So in the same way that in a business going out for meals, those operating expenses may be deductible in a different way, but depreciation only applies to tangible items that last longer than a year. So it has to have a useful life and not be consumed very quickly, like gasoline. You can't depreciate gasoline because it's intended to be used in the short term. Depreciable items have to be things that can wear out, decay, basically degrade over time. And so that if you have something like gold or diamonds that are durable and don't lose value, that can't be depreciated. And the items that you're actually making and trying to sell also aren't depreciable because the inventory or the product that you're selling should be separate from the machinery which was made to generate it. And it's the machinery itself that's generally depreciable. But it's more than just factory equipment that can be depreciated. It's also computers. It can be office furniture, and a wide range of things. On Wednesday, we're also going to be talking about depreciation, and part of what we'll have to do on Wednesday is look at the category of items, because the government has sort of a simplified approach for depreciation that depends more on what the item is than the rate that you would calculate in today's approach. So let me ask you sort of a conceptual question. We're getting close to the final exam. We're going to have some conceptual questions on the day of the final exam. So here's a practice one. Why would a business want their property to depreciate? Remember, a depreciation is a loss of value. And normally we think of that as a bad thing. But think of it from the business perspective. Who can take a stab at why would, if you're operating a business, why would you want your equipment to depreciate? What is it? A tax break, yeah. Now remember that depreciation is separate from the physical decay of your equipment. So you don't want your equipment to actually wear out, but what you do want is you want its value to be as low as possible on the books because you'll have to pay less in property taxes on it. And also, the faster you get the depreciation, the more of the deduction that you'll get. So keep that in mind that what we're talking about today is primarily related to the tax consequences of operating a business. So the first approach we're going to take today for depreciation is called straight line depreciation, and it's really easy to calculate. The way it works is that the item has a constant reduction in value each year. And so if you own a car, for example, and you paid $20,000 for it, and you think that car will last 10 years, then according to the straight line approach, if you depreciated it down to an a salvage value of 0, then it would be $2,000 per year. Declining balance, on the other hand, is a little bit more sophisticated because, as you might have already thought, vehicles don't depreciate on a straight line. They lose more of their value at the beginning of their useful life than towards the end. And so a declining balance approach, instead of having an equal amount each year, it's an equal fraction of depreciation each year. And so it's a certain percentage reduction year on year. You look at the value from the previous year, and this year's reduction in value is based on the previous book year, the previous year's book value. Sometimes salvage value is factored into declining balance, but not always. And you'll get both of those situations in today's in-class exercise. We'll have a straight line depreciation problem and a declining balance problem where you are considering the salvage value and also where you're not. On Wednesday, we're going to be talking about another system, the general depreciation system. It is based on property class, and it uses sort of pre-calculated tables for depreciation rather than actually having to solve the equations yourself. And so in some ways there's parallels to the table lookup method that you're already familiar with. We'll do that on Wednesday. So here's some more terminology. We've also talked about the first cost, or the basis. That's the installed cost of the asset, including transportation and training. The book value is how much the item is worth on paper at each year, T. So T means that we can calculate the book value at the beginning of its life and every year until the item is salvaged out. N is how long we expect the item to last, and the depreciable life of an asset in many cases is determined by government regulation. So they'll say that a sofa has a depreciation lifetime of 5 years. They'll say that water purification equipment has a depreciation timeline of 11 years. And so by category, they dictate how long things last. And that's separate from how long it actually lasts when it's put into practice. I mean, it should have a rough correlation there, but the market value is the actual value that you could get for the item if you sold it, and it's separate from the book value. You're already acquainted with salvage value. The depreciation rate is a fraction of how much is lost each year. And so the depreciation rate applies only when we're doing the declining balance method. It doesn't really come into play when we're doing the straight line method. Now, real estate, I want to point out that land can't be depreciated because it's durable, it doesn't wear out over time, but buildings on land can be depreciated. And when we do the general depreciation system on Wednesday, we're going to come back to the idea of the half-year convention. And what that means is that it is assumed by the government, when you're using the general depreciation system, that you only get half credit the first year because they don't want people buying things on December 31st and then getting a full year of depreciation just for owning it one day during a calendar year. So we'll talk more about that on Wednesday. Here's the formula for straight line depreciation, and it's very simple. You have the book value, which is the initial cost, the salvage value, which is what you expect the item to be worth at the end of its useful life, and N is the number of years. And then D sub T tells you how much of a reduction you get each year. So D sub T is the depreciation amount. And the book value can be calculated just by the beginning value of the item minus however many years there are that you're having this constant depreciation. So the amount is constant each year in straight line. And just as an illustration of that, let's say that you buy equipment that's $20,000. At the end of 5 years, it's $5,000. Well, you can calculate the depreciation amount. It's going to be $3,000 each year because it's the beginning and the end values. And the difference between those is $15,000, and it's over 5 years that $15,000 reduction occurs, and so that's $3,000 per year. And so you can find out the book value in any year by just having the initial amount minus however many years we're talking about, and then the depreciation per year. So here in this illustration, the book value in year 3 is 11,000. And if we do a graph of it, you can see it has the name straight line depreciation because a plot from the initial cost down to the salvage is straight, and we can find out the book value at any time simply by looking it up off of the plot. Any questions so far on the straight line method? Okay, declining balance is a little bit more fun because it's a fixed percentage that the reductions occur based on, and it is preferred by businesses. This declining balance depreciation is preferred because they get more of their depreciation early compared to late. And so let me ask you that, a new question. Why do you think that a company would rather have more depreciation soon rather than in the future? Instead of having $3,000 every year for the entire life of the item, why would you want, let's say, $6,000 this year, then $5,000 the year after, so that it's decreasing? Why is it better to get more early? Okay. It has the annual tax rates are going to be lower. And in addition to that, remember that money now is more valuable than money in the future. And so you want to take as much of the depreciation early on because present dollars are more valued than future dollars. So here's the formula for it. It's a little bit different. D sub t is the depreciation amount, and there's going to be this factor, lowercase d. I'll show you the formula for that in a moment. It's basically a fraction. Now the book value at t minus 1, that means the book value last year. T is just whatever year you're on, and so if you are in year 1, you want to find out how much depreciation there is for year 1, you'd look at what was the book value in year 0, which was the initial book value. So you're always looking at the previous year to calculate the depreciation amount for this year. Now here is how you calculate D. It is variable depending on if the problem statement tells you a certain percentage or if the problem statement tells you what the salvage value will be at the end of the book life. And so in that case, D is sort of implied by the initial cost basis and the salvage value, whereas D is calculated directly if you're given a percentage and the number of years that it lasts for. These formulas are on the in-class exercise paper. Now, if you want to find the book value at any given year, there's two ways of doing it. One is just look at the book value last year, and then you subtract the depreciation amount for this year. And so you just, on a spreadsheet, you'd look at the cell above, you'd subtract this year's depreciation, and then this year's book value is just last year's book value minus this year's depreciation. Very simple. Or you can calculate it directly. If you're not doing the row-by-row spreadsheet approach, you can calculate it directly with this formula, where you know lowercase d, that fractional reduction that occurs each year, and you'd substitute in t for which year you're in. So you could find the book value in year 7 out of 10 or something like that. So here's just a quick illustration of the declining balance method. Let's say that you buy a truck that's $80,000 and it's going to last for 10 years. We can find the depreciation and book value over time based on these two different methods. One is based on the percentages, and one is based on a salvage value. I'm going to do this illustration using Excel. You can follow along if you like, but it's not necessary. You'll get a chance to use Excel on the in-class exercise handout that I'm going to give you in just a moment. Okay, so part A, we're going to calculate this for 150%. So the first thing we put in here is 150 for the percentage. It's an item that's going to last for 10 years. The initial cost is $80,000. The salvage value, we don't put in a salvage value since we're using the percentage. So the salvage value will be blank for the first one. So we're using this formula to calculate D. So it's going to be the 150% divided by 100 times n. All right, so now we get this D is 0.15. Now, at year 0, there's no depreciation. That means you just barely bought the item. And so the book value is its initial purchase price. Okay, so the book value at the beginning of the item's life is how much you paid for it. Now, the depreciation amount for year 1, I'm going to use this formula down here. It is D, I'm anchoring that by pushing F4, multiplied by the book value from the previous year. So this year's depreciation is going to be $12,000, which means the book value at the end of the first year is the previous book value minus the depreciation for this year. And with that done, I can just drag everything down through the entire useful life of the item, and it'll calculate both the depreciation amount and the book value over time. So if we're going to do a graph of that, and gee, why not? Let's insert a quick graph here. We don't need this. Okay, this is showing the book value over time, and you can see that the slope of the line is decreasing, which means the business got more depreciation early on than they did later in the item's useful life. And so they get to take a $12,000 deduction against their income taxes in the end of the first year, but by the end of the 10th year, because the item is losing less value, their deduction is much smaller. Okay, so this other approach, where we use not the percentage, but where we use the salvage value, again, we have a 10-year useful life. It's got an $80,000 initial cost, and the salvage, we say it's going to go to $10,000 at the end of those 10 years. So here we're going to calculate D a little bit differently. It is 1 minus S divided by B to the power of 1 divided by N. Okay. Now I'll press enter on that. So the depreciation factor is a little bit larger, and that's because we expect the depreciation, the book value, to get to $10,000 at the end of 10 years. And this one, it only depreciated to $15,000. So there's no depreciation at time 0. And again, the book value is just the initial purchase price at the beginning. But now the depreciation at the end of the first year, we use the same approach. It is this factor times the previous year's book value. And then the book value at the end of the year is the previous year's book value minus this year's depreciation. All right, so we can slide it down, and hopefully when it finishes doing all the calculations, the book value at the end of year 10 should be $10,000. It is. All right. So that's the difference between straight line and declining balance depreciation. Any questions so far? All right, so I have an in-class exercise for you. If you brought your computer today, that's great. It'll make it a little bit easier to calculate part 2. If you don't have your computer, that's fine. All of this can actually be done by hand. So on the front page, please do it by hand. And then on the back page, if you have Excel available, then you can use Excel for part 2, which is on the back. I've got the key up on the screen if you want to take a glance at that. It seemed like most people were headed on the right track in calculating the depreciation amounts. Even though part 2 is a little bit more complicated, we can do it faster just because we're using the power of Excel to do all the number crunching instead of the power of Casio. All right, some of you are beginning to finish up, and so I just wanted to say a couple of things before you pack up and leave. So on the solution here, what we have is one approach that's using a defined percentage, another one that's using a defined salvage value, and then we have to calculate the implied D from that. We've already talked about the method involved, and so I won't repeat that again. Just one other announcement that came to mind is I think you're starting to get emails reminding you about course evaluations, right? Have those started coming through to you? I'd really appreciate it if you take the time to fill out the evaluations for this course. I'm interested in your feedback. I've already taken it once in the semester, and I'd be interested to know if you have specific suggestions so that when I teach this course the next time around, there can be improvements. It's challenging to teach this class when there's 3 different majors in here. It's hard to make it something for everyone, but if you've got ideas on how the course could be improved, I'd be really interested to hear it. So please be sure and do those evaluations. If you did this one by hand, this might be what your solution looks like.